All right, appreciate you checking out another video from Netpix. And again, as always, make sure you hit subscribe and like this video. If you do, questions or comments after, pop them below. And as you can tell, I always respond to the majority of questions. And so let's talk about the Fisher Transform Indicator. And if you're going, I have no idea what that is, I don't blame you, because it's not a very popular indicator. And when you put on your chart, it actually looks like the standard stochastics oscillator. And even the MACD, if you take out the histogram, has two lines. We call them the trigger line and the Fisher line. And there's actually 5 horizontal lines as well. You have the 1.5, you have the 0.75, and you have the 0. And then we have the negative 0.75 and then the negative 1.5. Now there are numbers that are higher and lower than these as well, but we're just going to talk about those 5. Now, essentially, this indicator is going to show when prices have reached an extreme. And when prices reach an extreme, a lot of traders look to trade a reversal. So it is possible that this could actually help you trade reversals. But I want you to keep in mind that the Fisher Transform, it's actually unbounded. So that means the trigger and the Fisher line, they can move well past those horizontal line levels. Right? So extreme readings on an indicator are often used to show overbought and oversold. So what's extreme? Well, that's a good question because it's unbounded. So there's no limit to how high or how low it could go. So there's no maximum values on either side. Let me just add that the Fisher calculation, it looks to normalize price movements, but there's very little evidence of a normal distribution of price in the markets, right? We're looking at outliers and gaps. But that's the intention of it. So if you want to use it, how are we going to use it? So the fact that all indicators have flaws, it doesn't make them useless. And with this indicator, there's a few uses for it. We can use a crossing of the lines. We can look at divergence, and we can look at oversold and overbought. So let's take a look at divergence first here. So a quick refresher. Divergence is simply price going one way, and indicators going the opposite. This is actually a daily stock chart, and you can see the price gaps to new lows, right? Gaps down. But then it closes back stronger than the open. So the Fisher is showing that the distribution compared to the recent past, it's not supporting this move lower. So price breaks a trend line, and my rules is that we have to have that last swing into lows connected. So we have to find a higher swing high than the previous one. And you can see the market here just heads higher. So one thing to note is that this stock, according to the indicator, was making extreme moves to the downside as it broke the -2 pretty often. So this particular move, when we compare it to the recent past, it's actually not an overly extreme move, right? It actually fit that past quite nicely. Let's look at another chart here. It's pretty obvious that the Fisher's not supporting these new highs. So then you would use whatever tactics you have to find an entry that's going to trigger you into a short trade. Now, just to touch on a few, you could use range breakouts to the downside. You can use trendline breaks. You can use failure tests of highs. You can use reversal price action. And if you just search on our YouTube channel here, you can find some information on those. Now, this is not designed to be a complete trading strategy tutorial, just to give you some insight into an indicator that some of you might find useful. Let's look at extreme moves. So remember, this is unbounded. So an extreme move is going to be a little subjective. But what we can do is we can compare the indicator now to the state in the recent past to give us a definition of extreme. So this is an hourly stock chart. You see price had a pretty good rundown. Puts in several bearish divergences at the highs. That gave us a trend reversal. So at the lows, prices run into previous support. And if we compare to the recent history of the Fisher, this is an extreme move. So we got price at support. We have an extreme move. We have no downside follow through. What would that equal? Potentially higher market prices. Let's look at Bitcoin. Now this indicator puts in an extreme at the highs, and then it begins to put in divergence. That's a pretty strong indicator of upcoming lower prices. We also have the indicator put in a double bottom on the right-hand side there. That's not an extreme move, but we could be looking to take action there on a double bottom. What about adding other indicators? Let's be honest, traders love to use indicators. The only one I'd really consider even using with this would be a moving average. Something longer term like a 50 will help give us trend direction. And then we can use the Fisher for the conditions that we just talked about. But quite frankly, the more indicators you use, the more you are removed away from price. Now, so we can use just simple trend structure of higher highs and lows, and also the reverse for trend direction, right? We don't need an indicator to tell us that. And once price action is not showing that pattern of higher highs and higher lows, well, we consider price to be in a trading range until it starts making lower highs and lower lows or moving back upwards. To me, it's just another indicator. The premise behind it, sounds fancy, but it may not be as valid as some people think it is. From gaps to outliers, normalized price distribution in the markets, it's not as clear cut as a lot of people may think it would be. But if you're a fan of trading divergences and you're looking for some market extremes compared to previous market action, then this indicator might be something for you to consider. But just understand that a complex calculation with a trading indicator does not mean it's better than any other trading indicator out there. All right, thanks for watching. Hit like, subscribe, and we'll talk to you soon.